Hey guys, welcome back to another episode of the Mogul Marathon Commercial Real Estate Podcast. I'm your host, Yannick Cudjoe-Virgil, and I'm very, very excited for our guest today. Today we have a guest that is an expert in self-storage investing, and he uses seller finance. So we're going to talk about self-storage today and really pick his brain on how he's currently operating in his market. And so today's guest is Gabe Petersen. Now, Gabe is the founder of Kaizen Properties and the host of the Real Estate Investing Club podcast. Gabe started his career as a management consultant for Fortune 500 companies in Seattle, Washington, but soon realized the corporate world did not fit the vision he had for his life. During his 7 years in corporate, Gabe tried his hand at building an e-commerce business, a t-shirt company, and even worked as a part-time digital marketing consultant. It wasn't until he bought his first broken down triplex in Tacoma, Washington, that he truly found his path in real estate. After selling that first triplex in 2014, Gabe had officially caught the real estate investing bug. And so now he owns and operates Kaizen Properties, buying and repositioning commercial real estate across the US with a special focus on self-storage and industrial properties. And so with his experience across many different asset classes and strategies, Gabe eventually decided to start what you know today as the Real Estate Investing Club podcast and YouTube show. Gabe, thank you so much for being a guest on our show.
Yannick, thanks for having me on.
So before we jump in, why don't you take a couple seconds to give our listeners a quick insight on your story and how you got to where you are today?
Yeah, for sure. I feel like my story, it's definitely not linear, but I feel like that's kind of the case with a lot of investors out there. I got started, as you said, in the corporate world, worked there for about 7 years in management consulting, doing mostly kind of project management style stuff, business analysis. But I never liked it. I didn't like the commute. It just really didn't fit my personality. And so I was always like trying to find the next step. Like, what am I going to do? I always wanted to start a business, but I couldn't figure out which business to start. I couldn't figure out, what to do. I didn't really have those influences growing up. So I didn't have a model to follow. And so I was doing all the types of things that you'd imagine, in your 20s. I'm sure a lot of guys out there listening to this, you did the same thing. You had Facebook feed would scroll across. You'd see e-com store, or start a drop ship store, start a digital marketing store. I did all those things. I had an e-commerce store. We brought it up to like 30,000 a month, but the margins were so thin. And I really did not like just sitting behind a desk and like staring at a screen all day. And so I kept trying new things while working the corporate job. And then in 2014, I flipped a triplex here in Tacoma with a buddy of mine, and we made like $80,000. And it was the most I'd ever seen in a single check. And I was like, okay, there's something to this. This works. But it wasn't until I did kind of real estate on the side, and I was wholesaling and doing some single family stuff. Bought a couple rentals. But it wasn't until 2019 when I made the leap, left my corporate job, and really dove into real estate. I started in commercial. I bought a mobile home park with some partners, and then we quickly bought another mobile home park. And in 2021, 2 years ago, I decided to take kind of an overview of all the different asset classes and choose one that I really wanted to focus in on, because that is where you really gain traction. When you figure out an asset class, you figure out how the business model works, and then you execute. So I chose self-storage facilities. I really like self-storage. And the rest is history. I bought since 2021, we've bought 5 facilities. This last, we'll go into this, but I feel like the market has really been tough in these last 6 months, just because there's a mismatch in the seller expectations and the buyer expectations. So those first 5 facilities were bought within probably a year and a half. And then we've been searching for our next deal, and that's where we're at.
That's awesome. There's so much to unpack there. Before we jump into it, I think the entrepreneurial journey that you've had is somewhat similar to mine because not a lot of people know about this, but I actually did try to start a drop shipping business while I was rehabbing my knee, trying to get back in the NFL.
There you go.
And I've always had that entrepreneurial like bug inside of me, whether it's a young kid, mowing lawns, trying to make it happen, selling things at school, trying to make a quick buck, or in this case, like you mentioned, the drop shipping, which I did make like one or two sales, but I quickly found that this isn't going to be for me, right? And then
Yeah,
I picked
yeah.
up the book Rich Dad Poor Dad, just like everyone else in real estate, and got the real estate bug. So it's very
Yeah,
very
Rich Dad Poor Dad,
interesting.
man. That shows up in that book shows up in so many different investors' stories, and in mine too. That's before I bought that triplex in 2014. I had read Rich Dad Poor Dad, and I read it in like literally
Yeah.
like a day. It's a tiny ass book, but I read it, and it really it aligned me to the power of real estate. And I appreciate what it has done to so many different investors' stories.
Yeah, yeah, absolutely, absolutely. So let's dive into the self storage business side of things, right? So how do you guys primarily? And I can totally understand where you're coming from a bid versus ask perspective, right? You have sellers that are out there that think their property is worth 2020 prices when interest rates were like 3%, right?
Yeah.
But now things are double, interest rates are like 6 to 7%. And as a commercial real estate investor, although we look at the deal from a totality perspective, we understand that interest rates have a big impact on our ability to absorb or take on the cash flow on a particular asset. So talk to us about how you're finding these deals and your strategy when you acquire these self storage facilities.
Yeah, I mean, I've done all off market so far. We find we do our own marketing and everything that everybody else does. So we do mailers, cold calling, texting, all the standard things. We just do off market marketing, get in contact with sellers, and then negotiate them that way. I have been recently looking, doing a little bit more networking with brokers and wholesalers, just because, I mean, as I said, the pool of really good deals has been it's been difficult to find great deals, and those are the kind of things that I've been wanting to close down as just killer deals. And so yeah, we do it off market, and so far what I've been very blessed and lucky to do is negotiate seller financing with the majority of the deals that I've closed. We get good terms. In fact, one of them we got, this was back when interest rates were around 3%. We got the seller to give us 2.67% interest on for an 11-year amortization period, which is just killer. And so I love seller financing. I think it's a benefit for both parties, for the seller and the buyer. It allows you a lot of flexibility. If the seller wants a higher price point, you can negotiate terms. So I love seller financing, and that's what we've done with a lot of the deals that we've closed.
That's awesome. That's awesome. I think that strategy in today's environment is even more key because in this environment, right, you can't just rely on just a straight up purchase to make deals work, right?
Yeah.
Interest rates have gone up astronomically. You really have to go into your toolbox as a real estate investor and figure out what are the multiple ways that you can carve out the deal, right? Is it just buying it straight up, going to a bank trying to get 75% LTV? Do you have the cash to purchase it, or can the seller give you some time to acquire the property under seller financing, reposition it, and hopefully when interest rates are in the next couple of years where interest rates have changed a little bit, that would be a little bit more favorable for commercial real estate investors. You can refinance out, extract some value out of it, and cash out this your seller financed seller. So when you are acquiring these properties, what's the strategy overall on these self storage facilities? Are we looking at top tier markets, high end self storage? Are we looking for a little bit more granular local self storage facilities? Because it's my understanding that population has a lot to do with self storage. Is that correct?
Yeah, your 3 mile, 5 mile radius population has a big impact on. Well, it's all dependent upon the each individual facility. Obviously, you really want to do a deep dive on the metrics around that facility to figure out whether it's a deal or not. But the main metric is net rentable square feet per capita. If there is, usually it's like 9 or 10 ish, it becomes a saturation point. So if you go above that, then it's not that it's not a deal. It's just that you just got to be wary. If there's too much self storage in the area already, we will invest in any market. We like larger markets. Obviously, Dallas is we own 2 facilities there. Love Dallas, but we'll invest in small markets too. And especially if it's on a main highway that connects to major markets, for instance, between like Houston and Austin, or any major market on a major highway. And so, yeah, the population is important. It's a good indication that you can be filled, especially if the net rentable square feet is low per capita. But it's not the end all be all. What we really like to see, and we really look at, is there has to be a positive net migration, and so the city has to be growing, has to be positive job growth, and then all the other small things that you'll look at when you're not small things, all the other things that you'll look at when you're doing a value add purchase. Is there an ability to expand? If they're at low occupancy, why are they at low occupancy? Do they not have a marketing plan in place? Do they not have for self-storage? It would be a gate, a fence, security system, all the things that people expect when they rent from a self-storage facility. So we look at those things to see if there's any value add that we can add there.
Makes total sense. And in the self-storage space, talk about maybe like your operations in depth behind, maybe if you're taking over properties from, mom and pop operators that are not necessarily like tech savvy, and repositioning it and making things a little bit more, easier for your tenants or customers that come in, and put things in a level that allows it to be a seamless process, right? From searching, finding your self-storage asset, to clicking a button, securing their unit, and maybe just streamlining that process. Can you give us some color behind that?
Yeah, and for sure. And that's one of the biggest value adds that we've been able to add to our facilities. A couple of them, the seller was just kind of tapped out. He wasn't really managing the facility well at all. He didn't have an online presence, didn't have a website, wasn't up on Google. He was managing everything with pencil and paper and pencil, and Excel, and so didn't have a good system to manage the tenants or the customers themselves. And so adding all those things, adding a website, getting on Google, putting up Google ads, getting on, some kind of CRM system. We use ESS. All of those things make a huge difference. And then also putting up proper signage, making sure that you're visible. We use QR codes. And so when somebody goes up to our facility, there's going to be a QR code that says, and when you're talking about hands-free or touchless renting, it's just they walk up to the facility, they scan the QR code, and they can rent a unit right there. And that also reduces your operational costs. One of the facilities that we bought had a full-time employee there, and we basically cut down on our expenses because that it wasn't a necessary hire. That person didn't need to be there. It could have been a remote facility, which we did. We put up signage, we put up that QR code, and we're able to fill it just with remote operations.
That's wonderful. So maybe give us some color behind one of the deals that you've done in the past. Would certainly love to hear more about the seller that gave you that 2.6% interest rates. Walk us through one of those deals so our listeners can really get a full grasp of the acquisition process of a deal that you've done in the past, and how you've already completed, or you're currently completing the business plan.
Yep. That low interest rate, that was a mobile home RV park out here in Moses, in Washington State. And so that was not self-storage. But it was still a great deal. It was a mobile home park. We got it for pretty cheap, and it was a good deal. It's 44 units. with it used to be a Camp of America, KOA kind of situation, and so had a big building at the front with an apartment on top. And so we rented out that the apartment, and then basically we're going to turn that lower level into apartments. And that one was a good deal just because we bought it at a good price. And I that's the weakest story when you're talking about value add, is you buy it at a good price, and that's the only reason that it's such a killer deal. But we got it at a great price. We got great financing, and worked out well. But another, I'm going to take you, because that one kind of has a weak story. A good story is this facility I closed last year in Indianapolis. It was, so let's see, it had 148 units, about, I think it was 15,000, 16,000 net rentable square feet. So kind of a smaller facility, but it was doing good numbers. It was also under market in rent, and it was at like 98% occupancy. So it was performing well, and it was at low. It was under market in rent. We went to the seller. We negotiated seller financing, and this seller wanted above what it would generally be worth. He wanted, I think it was like, 1.4 million is what we bought it for. But I think that was, somebody can do the math. It's like $75 or $80 per square foot. It's more than it's worth, but he was just foot down at that price. And so we're like, okay, we can make this work. Let's just negotiate seller financing. So we did. He gave us interest only seller financing, which is fantastic. I love interest only, which made it so that, cash flow is a lot better. And he gave us that for 20 years. And so we can keep that interest only financing in place for 20 years, cash flow. And the cherry on top is the facility is on large acreage. There's 5 buildings built out. It's already permitted for an additional 5 buildings. So we can double the footprint of the building. And so we bought the facility with that interest only financing. And then we changed over operations. We increased the rates to market. We lost a lot of tenants in the process, but now we're going back up. Once we hit 95% occupancy, we're going to begin the build, and then double. It's actually going to be more than double the footprint, because the way that they designed the original build plan was, it just didn't utilize the space very well. And so it'll probably be like 1.25, 125% of what the original footprint was. So we're going to more than double the footprint. Hopefully fill that up pretty quick, and it'll be a good deal.
That's perfect. I want to touch on 2 things that I think is really, really important for us to dissect, and what you said, as it relates to the price, right? Because I think in real estate, especially people who are new and getting into real estate, don't really understand the value of seller financing, right? And I think, one of the things that I know, that a lot of times, when you're in negotiations, it's either the price or terms, right? And not just because the price isn't what you should pay for it today doesn't necessarily mean that you can't make it up in the terms.
Yep.
Right. I think that is really, really crucial when you are looking at opportunities, specifically maybe in this market, right? I mean, interest rates are just astronomical, but I think as a whole, fundamentally, I think a lot of people get too caught up emotionally in price, when a lot of times there are different ways to skin the cat, if you would, when you look at it from a terms perspective.
Yep. Yeah, absolutely. And that deal, I mean, I wouldn't have been able to bring in capital for that deal at that purchase price, because it wasn't a good deal on paper. Like, if we had to go out and get a loan, then that wouldn't have made sense, even with the expansion. Mostly because if you take that 5% interest on the 1.4, and you go to a bank, you have to put 25 or 75% of that, or 25% down, and then you get 75% at 5% interest with the principal payment on top of that. The mortgage is going to be higher. It's just not going to make a ton of sense. But with interest only payments, it made a lot of sense. And then having that 20-year period, so you don't, we have a long runway to kind of get to where we need to be to do that build out, which is where the numbers really make it juicy. Then yeah, makes a lot of sense.
Yeah, totally agree. Totally agree. And so on the construction side for that particular deal, I would assume that the construction costs aren't really. I mean, you're just building boxes, right? It's not like multifamily where you have to worry about plumbing and HVAC. Talk about that a little bit as it relates to, your execution and just the simplicity behind the business plan.
Yeah, I mean, construction costs used to be a lot lower, but now, I mean, so we got a bid on the facility that we wanted to build out, and I think it was at $80 a square foot, which you can buy facilities for less than $80 a square foot, and so build costs are kind of high right now. We are looking to wait it out and see where it goes. Um, but yeah, even at $80 a square foot, if we build it, then it's going to it makes sense financially in terms of what it should bring in, because we can do right now the facility is 100% outdoor drive up, but we can do interior climate controlled, which can rent at a premium, and so should be good.
That's perfect. And so are you on the construction side of things? Is it because of interest rates? I'm just curious about how you guys are maybe financing the construction piece for the additional square footage. Is it the interest rates that are holding you back? You think that the construction loans are just a little bit too pricey in today's environment versus what you might pay, say, a year from now if the Fed decides to come down on rates.
I mean, it's both interest rates and it's the cost of construction. So you used to be able to build per square foot and in like the $50 to $60 range, and now it's up to the $80 range. And I'm not saying that it definitely will go down, but as we understand it, we think it should go down a little bit. And that's kind of what we're holding out for. And this is all dependent upon us. The business plan says that we're going to wait until 95% occupancy at our current footprint with market prices. Once we hit that point, then we go into the expansion. And so we're really, once we hit that 95% occupancy rate, that's when we're going to revisit the numbers and see where construction costs are, see if we want to take on, and interest rates, if we want to take on that debt with the income that it should bring in. Based on our initial underwriting, it should make sense regardless, but it's just something that we're considering. We're going to consider when it actually happens.
That's perfect. That's perfect. So talk about your podcast. I know that you have a coaching platform as well. Maybe some of our listeners are excited about what you're doing. They want to get into self-storage. How can our listeners, follow you and be a part of your mastermind?
The Real Estate Investing Club. It's a podcast at therealestateinvestingclub.com. I have people on from every asset class. I love learning. And that's what I love about real estate is there's so many ways to do it. There's so many business plans, so many asset classes that you can jump into. So we interview them all in the Real Estate Investing Club. And yeah, we haven't launched the coaching program yet. I've been too focused on the deals that I've been doing. I have the structure built out, but I haven't put the final bells and whistles on it. But we should be launching it at the end of 2023. So around the September area, we should be able to be launching that. When it does go live, we're going to be having a group course and then also a one-on-one that we're going to be offering.
That's perfect. Gabe, we talked a lot about, self-storage, your strategies, seller financing, one of the deals that you're working on. Just a lot of, I think, actionable information we talked about today. So thank you so much for being a guest on our show. Thank you to all of our listeners for tuning in to another episode of the Mogul Marathon Commercial Real Estate Podcast. Let's take action, be great, and remember that real estate is a marathon, not a sprint. So run your own race. Thanks again, Gabe.
Love it. Yeah. Thanks, Yannick.